On the first morning of a new year, the city wakes slowly. Office lights flicker on one by one, coffee machines hum, phones glow with notifications that no one truly wants to read. Headlines talk about inflation, layoffs, and markets that move like restless oceans. Somewhere in that quiet morning sits a person who could be anyone. Maybe someone scrolling through a banking app before work. Maybe someone staring at a paycheck that disappears before the month even begins. The number at the bottom of the screen feels heavier than it should. 0. Not dramatic bankruptcy, not catastrophic failure, just nothing built yet. No investments quietly growing in the background, no safety net waiting patiently in a savings account. Just income coming in and flowing right back out. For many people, this moment becomes a silent conclusion. They assume the system must be impossible to win. They assume investing is a game for people who started earlier, earned more, or somehow knew the rules before everyone else. So they stop before the game even begins. But something subtle is happening beneath the surface of that 0. Because the real starting point for most people isn't 0, it is negative. There is an invisible anchor that quietly drags behind modern life. It rarely announces itself as a crisis. Instead, it shows up as a routine monthly line on a bank statement. Credit cards, consumer loans, small payments that feel harmless because they are spread across time. This is what might be called the negative compounding trap. Compounding is usually described as magic when it works in your favor. Investments growing year after year, interest building quietly in the background. But compounding works both ways. When interest rates climb above 20%, the same mathematical force becomes something else entirely, a slow erosion of the future. Imagine a small debt of $5,000 quietly sitting on a credit card at 24% interest. The monthly payment looks manageable. It blends into the background of life like a streaming subscription or a phone bill. But the math underneath tells a different story. Left alone long enough, that small balance quietly doubles. The numbers don't shout, they simply grow. And every dollar sent toward interest becomes a dollar that never had the chance to grow for you. This is why many people feel like they are running on a treadmill financially. They work harder, they earn a little more, they try to invest small amounts on the side, but the invisible gravity of high-interest debt keeps pulling them backward. It is the financial equivalent of trying to fill a bucket with a hole at the bottom. The water never stays long enough to accumulate. What makes this trap so powerful is not only the math, it is the psychology. Debt slowly trains the mind to operate from scarcity. When someone owes money, they hesitate before taking risks that might actually improve their life. They stay longer in jobs that drain them. They delay asking for raises. They avoid opportunities that require courage, not because they lack ambition, but because fear quietly takes the steering wheel. Every obligation to a bank quietly reduces the freedom to make bold decisions, which leads to an uncomfortable realization. The true cost of debt is rarely the interest rate printed on the statement. It is the life someone becomes too cautious to pursue. Breaking that chain requires something that feels almost unfashionable in a world obsessed with investing apps and market predictions. Before building wealth, the ground must be cleared. This is where a simple but ruthless strategy begins. Every liability is written down in one place, not organized by size, but by interest rate. The most expensive debt sits at the top. Then the attack begins. All spare income flows toward the highest rate first, while minimum payments keep the others from growing. Old subscriptions quietly disappear. Unused items find their way onto resale sites. Small luxuries temporarily step aside. The process feels aggressive because it is, not out of punishment, but out of urgency. Because mathematically speaking, eliminating a 20% debt produces something that no stock market can guarantee, a risk-free 20% return. Few investments in the world can compete with that. And something unexpected begins to happen as those balances shrink. Breathing becomes easier, decisions become clearer, life slowly regains a sense of possibility. Yet just as the last payment disappears, another quiet trap waits patiently around the corner. A trap that destroys more new investors than bad stock picks ever could. Because the moment someone finally becomes debt-free, a dangerous thought appears. Now it is time to invest everything. But what happens when life interrupts the plan? When the car breaks down, when the job disappears, when the market falls at the exact moment money is needed most? That is the moment when wealth building quietly collapses for most people. And the reason lies in something surprisingly simple: a missing buffer. A shield that most people skip because it feels boring. But without it, even the best investment strategy becomes fragile. Which raises an unsettling question. What if the first real step toward wealth isn't investing at all, but building something far less exciting? A fortress made entirely of patience. Imagine two people beginning their financial lives on the same day. Both are disciplined, both read about investing, both decide the future belongs to those who enter the market early. At first, their paths look identical. Every spare dollar flows toward investments, charts are checked during lunch breaks. Headlines about technology companies and global markets feel like signals from the future. But life rarely moves according to financial plans. One afternoon, a car engine fails. Another month, a job disappears without warning. Suddenly, the difference between these two investors becomes painfully clear. The first investor has no cash reserves. Every dollar sits inside stocks that happen to be falling during a market correction. Selling those shares now means locking in losses just to pay rent and groceries. The second investor faces the same crisis, but instead of touching investments, they quietly open a savings account and pay the bills from a small emergency reserve. The market eventually recovers. One investor restarts from nearly nothing. The other continues exactly where they left off. This difference might appear small on the surface, but over decades it becomes enormous. Because successful investing often depends less on choosing the perfect asset and more on never being forced to sell at the worst possible moment. This is where one of the most misunderstood ideas in modern finance appears: cash. In many corners of the internet, cash is treated like a mistake, something foolish people hold while inflation slowly erodes its value. But early in a financial journey, cash serves a completely different purpose. It is not an investment, it is insurance for the mind, a quiet financial buffer that separates emotion from decision. Without it, every market drop feels like a threat. With it, volatility begins to look like opportunity. 3 to 6 months of essential living expenses sitting quietly in a high-yield savings account may not sound exciting. There are no dramatic gains, no thrilling market updates. But that stillness contains something powerful: stability. And stability changes behavior in subtle ways. When someone knows they could survive several months without income, they negotiate differently at work. They think more clearly about career moves. They stop reacting to every financial headline like an emergency alert. In other words, the buffer creates psychological distance, and distance allows rational thinking to return. Once this quiet fortress is built, the conversation about investing finally becomes meaningful, because now money entering the market can stay there long enough for compounding to do its quiet work. This is where another common misunderstanding appears: the idea that successful investors must constantly search for the next winning stock, the next revolutionary company, the next story that promises extraordinary returns. The temptation is understandable. Finding the next great company feels heroic, like discovering treasure before anyone else notices. But the data from decades of market history tells a humbler story. Even professional fund managers, equipped with advanced tools and entire teams of analysts, struggle to consistently outperform broad market indexes. Over long periods of time, more than 90% fail to beat something as simple as the S&P 500, which reveals a strange truth. Building wealth rarely requires brilliant predictions. It often requires something far less glamorous, accepting average. Because the long-term average return of the stock market, roughly 10% annually before inflation, has quietly created millions of millionaires, not through excitement, but through persistence. This leads to a strategy that feels almost too simple to be impressive. Most investments flow into broad, low-cost index funds that represent entire markets rather than individual companies. Instead of hunting for the perfect needle in the haystack, the investor quietly buys the entire haystack, and history shows that the haystack tends to grow. Yet human psychology still craves excitement. Watching an index fund slowly rise over decades rarely produces the dopamine rush people secretly want. So a clever compromise appears: the core and satellite approach. The core, perhaps 90% of investments, remains disciplined and boring inside diversified index funds. The satellite, perhaps 10%, becomes a playground for curiosity, a small portion of money where experiments can happen: individual stocks, new technologies, even speculative assets. If those bets succeed, wonderful. If they fail, the foundation remains untouched. This structure satisfies both logic and human nature. But even after saving, investing, and controlling risk, one silent leak still waits in the system, one that quietly drains wealth over decades without making headlines. Taxes, the place where millions of dollars quietly disappear from otherwise successful portfolios. And the solution is not complicated. It simply requires understanding where money lives. Accounts designed for retirement, such as tax-advantaged investment accounts, allow investments to grow without constant taxation eating away at the results. Over 30 years, the difference between taxed growth and tax-protected growth can easily reach tens of thousands of dollars, sometimes far more, all because of a decision made at the beginning. But even after optimizing debt, savings, investments, and taxes, one final lever remains, the most powerful lever of all: income. Expenses can only be reduced so far, but income has no theoretical ceiling, which raises a deeper question that many people quietly avoid asking themselves. What if the real engine of wealth is not the spreadsheet, but the person staring back from the mirror? Somewhere between budgeting apps and investment charts, a quiet illusion takes hold. It is the belief that wealth is mostly about cutting things out. Skip the coffee, cancel the subscriptions, buy fewer things. There is truth inside that advice. Wasteful spending does slow progress, but something important often gets lost in that conversation. Defense alone never wins the game. A person can spend years perfecting small savings habits and still feel stuck in the same financial place, not because discipline failed, but because the scale of the problem was never addressed. Living costs rarely stay still. Rent moves upward. Food becomes more expensive. Insurance, transportation, healthcare, each quietly inching higher year after year. Meanwhile, income, for many people, moves slowly, sometimes painfully slowly, which means the real leverage point of financial life may not be the budget, it may be the income engine. Imagine two people again. Both save 20% of what they earn. One earns $50,000 a year, the other earns $100,000. The discipline is identical, yet one investor contributes $10,000 annually to investments, while the other contributes $20,000. Over 20 or 30 years, that difference quietly compounds into something massive, not because one person invested better, but because one person controlled a larger shovel. This realization shifts the conversation in an uncomfortable direction, because improving income often requires something more difficult than saving money. It requires growth, learning new skills, changing industries, negotiating raises, starting from the uncomfortable position of being a beginner again. And human psychology naturally resists that discomfort. Low-friction income options always appear more attractive. Driving a car for a rideshare platform, taking small online gigs, selling random items occasionally. These activities generate money, which makes them feel productive, but they often share one critical limitation. They are linear. The moment the work stops, the income stops as well. There is no compounding advantage. Contrast that with acquiring a high-leverage skill, something that increases the value of every hour worked. Data analysis, technical programming, specialized sales, project leadership, skills that companies compete for. When income increases because of skill, something remarkable happens. Every other part of the financial system accelerates. Retirement contributions grow. Employer matches increase. Investment capital multiplies. Even confidence shifts. A person who knows they possess valuable skills no longer negotiates from fear. They negotiate from capability. Yet the path toward those skills rarely feels glamorous. It often looks like quiet evenings spent learning after work, reading documentation that feels confusing at first, practicing presentations in empty rooms, completing certifications when friends are relaxing. Progress appears slow, which is exactly why most people abandon the process before it compounds. But compound growth in skills behaves remarkably like compound growth in investing. Small daily improvements eventually reach a tipping point. A new role appears. A raise becomes possible. An entirely different career trajectory opens up. What once felt impossible becomes normal. The most powerful parts of this transformation is not just the money. It is the change in identity. Someone who once believed their financial future was limited begins to see themselves differently, not as someone trying to survive the economy, but as someone capable of shaping their place within it. This leads to a simple but powerful practice, a skill audit, looking honestly at current work and asking one question: what single skill, if mastered, would make this role undeniably valuable? Perhaps it is public speaking. Perhaps it is advanced spreadsheet modeling. Perhaps it is understanding how systems and data interact. Once identified, the commitment becomes clear. 1 hour per day. The same hour that might otherwise disappear into endless scrolling or passive entertainment. 6 months of focused effort may not change the entire world, but it often changes enough. A conversation with a manager feels different. An interview becomes possible. A salary negotiation carries real weight. And suddenly, the financial system built earlier, debt elimination, savings buffer, disciplined investing, begins moving faster. The machine has finally been given fuel. Yet even with rising income and growing investments, one final test remains. Because wealth does not only grow through numbers, it grows through behavior. And behavior becomes most difficult during moments of excitement or fear, which raises the final challenge of the entire journey. How does someone stay disciplined long enough for decades of compounding to unfold? Because the greatest threat to wealth is rarely the market. It is impatience. The most surprising truth about wealth is that it rarely feels dramatic while it is happening. There are no cinematic montages, no single moment when someone suddenly becomes financially secure. Instead, progress unfolds quietly, month by month, contribution by contribution. At first, the numbers feel small. $500 invested each month does not look like much when the portfolio balance sits at $2,000. Even after the first year, the growth may barely be noticeable. This is the phase where many people lose patience, because the brain naturally seeks visible progress. Without it, motivation fades. But hidden beneath that slow beginning is the force that eventually changes everything: compounding, a force that behaves like gravity for money. At first, it pulls gently. Then gradually it becomes impossible to ignore. Consider what happens when someone consistently invests $500 per month into a diversified portfolio earning roughly 10% annually. After the first year, the portfolio might reach around $6,000. After 5 years, perhaps $40,000. Still respectable, but not life-changing. Yet somewhere around year 10, something interesting begins to happen. The investment returns themselves start generating returns. The portfolio no longer grows only because of new contributions. It grows because the existing capital has become productive. By year 20, that quiet discipline may create a portfolio approaching $400,000. By year 30, the number can approach or exceed 1 million. Not through luck, not through extraordinary predictions, but through patience and consistency. Which reveals a strange paradox. The method that builds wealth most reliably is also the method that feels the least exciting. Buying broad market index funds, automating contributions, ignoring daily market noise. There are no adrenaline spikes, just the steady accumulation of ownership in thousands of companies quietly producing goods, services, and profits. For many people, this simplicity feels unsatisfying, so they search for shortcuts, day trading, options speculation, cryptocurrency trends that promise explosive gains. Occasionally, those bets succeed, but over long periods of time, most of them end the same way. The investor becomes distracted from the quiet system that was already working. The irony is that the wealthiest, long-term investors often appear almost boring in their habits. They automate contributions, they avoid emotional reactions to market swings, they focus more energy on increasing income than on predicting stock prices. Their strategy does not depend on excitement, it depends on endurance. Because financial markets, like seasons, move through cycles, booms and crashes, optimism and panic. But over long periods of time, human productivity continues expanding. New technologies emerge, businesses grow, entire industries evolve. And those who quietly own pieces of that system benefit from its expansion. This does not mean the journey is always smooth. There will be moments when markets fall sharply. Headlines will predict financial collapse. Friends may chase speculative trends that appear more exciting. Those moments test discipline more than knowledge. But the person who remembers the original structure of the plan stands on stronger ground. Debt eliminated, emergency buffer protecting against life's surprises, tax-efficient investment accounts quietly compounding, income steadily increasing through skill development, each piece supporting the others, like the foundations of a building designed to last decades rather than seasons. Over time, something subtle changes. The anxiety that once surrounded money fades. Decisions become calmer. Work becomes a choice rather than a necessity. Freedom appears not as a sudden windfall, but as the gradual widening of possibilities. And the person who once stared at a bank account showing 0 realizes something profound. The starting number was never the most important part. The strategy was. Because wealth, in the end, is rarely created by dramatic moments. It is built by ordinary decisions repeated long enough for time itself to become the greatest ally. And somewhere years later, perhaps on another quiet morning, the same person opens a financial app again, but this time the number at the bottom of the screen feels different, not because it appeared overnight, but because patience finally revealed its power. There is a moment in almost every financial journey that arrives quietly. No celebration, no dramatic music, just a number on a screen that suddenly feels alive. For years, the process looked ordinary. Income came in, a portion quietly moved into investments. Months passed where nothing seemed to change. Then slowly, something begins to shift. The portfolio no longer feels like a fragile experiment. it begins to feel like a machine that produces growth even when no one is watching. This is the stage where many people experience their first real glimpse of financial momentum, not because they discovered a secret stock or predicted the next economic trend, but because the structure they built finally had enough time to start working. Time is the invisible partner in every successful financial story. At first, it feels like an enemy. People want faster progress. They want visible proof that their efforts matter. But time does not reward urgency. It rewards consistency. Think of wealth not as a sudden victory, but as something closer to planting a forest. In the beginning, there is nothing but soil. Then small seeds appear. For months, perhaps even years, growth happens mostly underground, roots spreading quietly where no one can see. Anyone who walks by might assume nothing is happening, until one day, the surface begins to change. Small trees appear, then shade, then an entire ecosystem begins forming around them. Financial compounding behaves in almost the same way. The early years feel slow because most of the work is happening beneath the surface. Habits forming, systems stabilizing, skills improving. But eventually, the structure becomes powerful enough to support real growth. And something surprising happens during this phase. The relationship with money begins to transform. Earlier in life, money often feels emotional. Fear when the balance is low. Excitement when something new can be purchased. But as wealth gradually accumulates, money becomes quieter, less dramatic. It shifts from being the center of attention to becoming a background tool. The real reward is not the number itself. It is the freedom of options that number quietly creates. Freedom to leave a job that no longer feels meaningful. Freedom to explore new projects without financial panic. Freedom to say no when something conflicts with personal values. In other words, wealth expands choice. And that expansion of choice is often the true goal people were chasing all along. Yet even here, another subtle psychological trap appears. When financial stability begins to grow, lifestyle expectations tend to grow with it. A nicer apartment, a newer car, more expensive routines that quietly become normal. This phenomenon is often called lifestyle inflation. It is one of the quietest ways wealth disappears, because spending always finds a way to rise toward income unless intention holds the line. The solution is not extreme frugality, nor is it denying every comfort. Instead, it is a deliberate awareness of what actually creates happiness. Many people eventually discover that satisfaction rarely comes from accumulating more things. It often comes from having more control over time. More time with family, more time for meaningful work, more time to explore curiosity. Money becomes valuable not because it purchases luxury, but because it protects autonomy. And this realization brings the entire journey full circle. Because the person who once woke up staring at a financial starting point of 0 eventually understands something deeper. 0 was never the problem. Confusion was. Lack of structure was. The absence of a clear path forward was. Once those pieces were replaced with a simple system, eliminating destructive debt, building a financial buffer, investing consistently, protecting growth through tax advantages, and increasing income through valuable skills, the outcome was almost inevitable. Not immediate, but inevitable. The system itself quietly carried the weight. And perhaps that is the most powerful truth hidden inside personal finance. Wealth is rarely built through extraordinary intelligence. It is built through ordinary discipline, through habits repeated long enough that time itself becomes the greatest investor. So the next time someone wakes up at the beginning of a new year staring at a balance that feels discouragingly small, there is another way to interpret that moment, not as a verdict, but as the opening line of a much longer story. A story where the numbers slowly begin to breathe, where patience becomes visible, and where the quiet decisions made today gradually transform into freedom tomorrow. Because the journey to wealth rarely begins with $1 million. It begins with something far more modest, a single decision to start.